In less than 3 minutes, let's talk about some things you probably didn't know about mutual funds. A mutual fund is made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market, and other assets. Mutual funds are managed by professional financial managers who allocate the fund's assets by buying and selling securities within the fund. Many mutual funds give individual investors access to well-managed and diversified portfolios at a low price. When you pick a mutual fund, be sure to know the differences between active investing and passive investing. You can check that out in my previous video. The amount of money you need to invest in a mutual fund depends on the mutual fund. A lot of mutual funds right now have free or no minimum investment amount, but some mutual funds require you to have minimum investment amount like $3,000, $10,000, $25,000, or sometimes even $100,000. You also need to make sure you understand their expense ratios and the turnover rate. The expense ratio of a mutual fund basically means an annual fee a mutual fund charged to the investors. It's the management fee and administrative cost to maintain a mutual fund. Some mutual funds charge investors both management fees and annual operating expenses. For example, a mutual fund could charge you a 1% management fee and another 1% for total annual operating expenses. In this case, your management expense ratio, or MER, is 2%. You also need to understand if the mutual fund charges you commission or sales charges. If a mutual fund has a front-end load, fees are assessed when shares are purchased. For a back-end load, mutual fund fees are assessed when an investor sells his or her shares. You can also find investment companies that offer a no-load mutual fund which don't carry any commission or sales charges. You have to do your own research to find out how much these funds charge you. They can have a big impact on your investment returns. You could save tens of thousands of dollars in the long term if you find a mutual fund with a low expense ratio and a low turnover ratio. For example, Vanguard's index mutual funds have average expense ratio of 0.09%, and let's compare that to the industry average expense ratio at 0.54%. With $50,000 initial investment amount, your expense ratio with 0.09% is about $7,600. With the industry average expense ratio at 0.54%, it's about $43,000 in 30 years. A mutual fund with low expense ratio could save you over $35,000 in 30 years. Thanks for watching. Don't forget to check out these two 3-minute videos as well as the new FIRE video coming out tomorrow, Sunday at 9 a.m. Have a good one. Thanks for watching. Don't forget to hit the like button and subscribe for more FIRE videos.